The accuracy of the product cost depends on how accurately indirect costs are allocated. Here we rely on what departmental heads have said about the services that they have provided to other departments. Another option is indirect cost of the 17 lakh can be allocated to the two plants on the basis of number of employees or machine hours. There is no guarantee that the amount allocated to these plants are correct. At times it may lead to wrong decisions. Let us take a large retail business like a big bazaar. The business model is centralized procurement of goods from direct sources, bring all the items to the central warehouse and distribute the item to retail stores. The challenge is how to allocate the warehouse and distribution costs to numerous products. An easy option is allocate the cost on the basis of the procurement cost. Suppose the retail business computes the ratio of a last year warehouse expenses, distribution expenses and shop level expenses, pool them together and divide this by a total procurement cost. It finds this ratio as a 30%. It fixes a selling price equal to procurement cost plus 30% for warehouse, distribution and another 10% for profit margin. This approach looks simple. Many accountants will prefer to use this method of costing. This completely distorts the product cost and final price. Let us take two products to show how costs get distorted. The basic product cost of, let us say, 100 milliliter of a perfume is 400 and 10 kgs of a wheat flour that costs about 380. The company now adds 30% of the product cost as overhead. The total product cost of 100 ml of a perfume is now 520. 10 kg of a wheat flour now costs about 494. The retail store adds another 10% towards profit and fixes the selling price. The cost allocation is arbitrary. Transport cost of 10 kg of a wheat flour will be significantly more than transporting 100 ml of a perfume. Perfume does not require any of the warehouse services except unloading and loading, but still we load 40. Wheat flour would require unpacking, cleaning, repacking, but it takes only 38. The assumption here is if the price of the product is more, it should bear more overhead. It is not correct. With this cost structure and price, the perfume price will not be competitive in the market. Perfume is overcosted, wheat flour is undercosted. There is a possibility the perfume is not sold by the shop for a long time because the cost is high. Finally, the shop may have to sell the perfume on sale by offering 50% discount. An otherwise high profit margin turned out to be a loss-making product. Let us consider one more example to highlight this point. This company called Leatherite manufactures variety of leather products. The firm started with a single product 3 years back. Due to competition, it could use only 50% of the capacity. The firm started taking orders and started manufacturing customized products. Nearly 50% of the current capacity is used for customized product. The remaining 50% is used for a standard product. The costing system was designed for a single product earlier by the company. The overhead was allocated based on the number of units, and the practice is continued even today. Assume you are a manager of the firm. You got a report from the accounting department showing the profitability of the products. The product P1, which is a standard product, and the price is determined by the market forces. Accountant shows the product cost as 290. It consists of 200 for the material and 90 for overhead. The selling price determined by the market forces is 264. The product is incurring a loss of rupees 26. P2, P3 and P4, these are all customized products. Prices are quoted by the firm by adding a material cost, overhead at the rate of rupees 90 per unit and profit markup of 20%. Accountant shows all the customized product earn profit. Their selling price is more than the material cost and overhead. Using the cost data, you ask the sales team to focus more on customized product, thinking they are more profitable. You also ask them not to focus too much on P1, which is a standard product, because it is a loss making. Anything wrong in this decision on the face of it? Overhead cost will now increase further as we move from standard product to customized product. Now, some of the customized product will turn loss making or less profitable. Your decision to increase the profit has actually resulted in increase in the cost and lower profit. The reason is you are using a wrong cost data. The reality is substantial part of the overhead is on account of customized products. Most of the overhead like designing, sampling, order processing are not at all related to the standard product. But still 50% of the overhead cost is loaded on the standard product. Further analysis of overhead shows only 10,000 is related to P1 and the remaining 80,000 is related to the customized product P2, P3 and P4. Suppose we use this data. You will now charge only 20 as a overhead for P1 and 160 per unit for P2, P3 and P4. With this correction, your accountant will produce a different product profitability statement. P1 and P4 are now profit making, P2 and P3 are loss making products.